Okay, well, it's right at 2 o'clock, and we've got a lot of ground to cover today because, as you may be seeing in the Zoom, we've got a special guest that we definitely want to save some time for. But before I get to that, welcome to the October edition of Market Matters. Here's our brief agenda. We're going to touch on both the economic update, which is actually very fluid right now, the investment outlook as kind of we see it next quarter in January, we'll go over the 23 outlook. And then I definitely want to leave the bulk of the time today for our special guest, Mike Townsend. He's been on Market Matters a couple times, so definitely appreciate Mike coming back to lend his ideas and thoughts on the current political environment and how that might be affecting what we will be doing on our end. He's the managing director of legislative and regulatory affairs for Charles Schwab. So a great voice in advance of a midterm election season, which is always going to be a little silly sometimes, or a little crazy. So look forward to hearing Mike's thoughts on that. Let's turn briefly to the economic update. And you'll notice, for those of you that have been on these for a number of months in a row, I'm really focusing thoughts or comments on the ISM services and manufacturing indexes. Services line is in purple, manufacturing line is in orange. And just a couple of things to point out here. One is that certainly the orange line, so just to orient you, any number on the screen, on the y-axis that's above 50 means that sector of the economy is in expansion. Any number below 50 means it's in contraction territory. What you can see is we've got manufacturing kind of getting very close to a contractionary indication, where you've got 50.9 was the most recent reading. More importantly, though, I think is this idea that the services sector has been very stable for the last few months, actually increasing since July. And that really is sending some mixed signals. So again, I think it's still too early to call because there is a lot of puts and takes with the various economic conditions, a little bit in flux. But the two largest parts of the economy are still in expansionary territory. And the biggest part is services. So, I still think that the bias, at least for the foreseeable future, and according to real-time indicators of GDP for Q3, are that we're likely to see a pretty decent bounce in economic activity in Q3. The inflation update, this isn't updated as of today. I think there's a report coming out either later today or tomorrow. I think it's actually tomorrow, showing CPI. So it's going to be a big report to keep an eye on. And as you all know, what is important for us to keep in mind is, when is that magic number going to reach below 6 on a trailing 12-month average? Because that number tends to be when both stocks and bonds start to feel better about the world and actually move into a positive return territory, at least from data going back to the 1920s. So based on the most recent readings, somewhere unfortunately between June and July is when we're on current trend, is when we're going to hit that level. So this also helps inform, I think, some of our thoughts around the markets at the moment, which is certainly there's going to be some evolution of CPI up into that point, but we're likely in for some choppy waters in both the stock and the bond market until we get to that point. This is a great chart from Schwab. Unfortunately, it did grain out a little bit, but what you can see here is the Fed change in the Fed funds rate over the last 30 years, or actually maybe 40 years. And then what's important, though, is that it's not the rate, but it's the rate of change. And you can see here the reason why the markets are responding so negatively to what the Fed is doing is that this particular tightening cycle, we've gotten to the change in the Fed funds rate at this 3% level, the fastest in any point in the last, call it 40 years. And that really is lending itself to this idea that, a lot of people feel like, quote unquote, something needs to break. You are starting to see things in financial markets globally that are breaking, the UK being the prime example there. But the US noticeably has not had any significant issues like that. So I think a lot of people are waiting for a shoe to drop. I'm not so certain that that's going to be the case, given the financial sector is on much better footing than it was, back in 2007 or 8. But nonetheless, we should certainly be looking for some, around the fringes issues with certain markets to get a little more hairy And this is why, again, we've got such a good, calamity in the bond market on our hands at the moment. One thing we are looking for, I really haven't touched on this in the past, but it's really important to keep in mind what's also happening in the currency markets, because currency markets are moving faster, at least internationally, than they really have in, gosh, maybe 40, 50 years. Interestingly, almost every developed currency, with the exception of the yen and the Australian dollar, are at parity with the US dollar. Whether it's the euro, the British pound, Swiss franc, are all at parity, which has not been the case for a long, long time. And the dollar going up in value versus all other currencies is actually importing deflation into the US, but exporting inflation outside of our borders, which is why a lot of countries have an issue with the monetary policy the Fed is putting forth at the moment. But the reason why I want to show this chart is, number one, the $120 level on the dollar index seems to be a very important level. So that's just something we'll be keeping in mind historically. But number two is when the dollar starts to fall, and I've been saying this for a number of years now, when the dollar starts to fall in a meaningful way, that's when we'll know, I think it's time for us to shift our tactics and think a little bit more in terms of international investments, because until that time, the dollar is just going to be sucking in capital into US assets, and that tends to have a compounding effect over short intermediate terms. So we're watching, very carefully what's going on with the dollar. And, I think it's still important to keep in mind, because there is so much negative pessimism out there in market and sentiment indicators that, what could go right. We've seen a couple of things happen over the last few months. There's been negative sentiment readings, reversing course very quickly, like in August, only to turn back around in September. So this is definitely moving around a lot more. Compromised U.S. tax reform bill, that was certainly something we outlined many months ago, which Michael talked more about. But cessation of conflict, I think this shouldn't go. I mean, there's a lot of people with strong opinions on this, but if in fact there's a way to find some sort of what they call golden bridge in the Russia-Ukraine conflict, that would go a long way to pulling some risk premium out of a variety of different markets, and in which case, could usher in an era of a new bull market just by that fact alone. We're starting with starting valuations in equities and bonds actually more in the normal range for the first time in a long time. That really could be a pretty massive catalyst. And then, of course, inflation declining faster than expected would be really welcome. So let's take a look at the investment outlook just briefly. Really no change since the end of Q3, which was last in September. So this is we still are very oriented in the approach that we have at the moment. I would say parts of the fixed income market again are getting really interesting. The junk bond or high yield market, particularly for shorter term bonds, is getting really attractive, where you're talking about 1 to 2 year duration high yield bonds at 5 and 6% yields. That's not a bad starting point. High yield indexes actually are approaching 9. And I think for us internally, if high yield indexes get to a level of over 12, that would probably be the time when we would start legging into that exposure again, after not having owned high yield bonds for the better part of a decade. Emerging market bonds, they're in dollar terms yielding right around 10%. There's still a lot of, I think, yield rise to go before those get attractive. But again, somewhere in that 12 to 15% range is something we're finding really interesting. I would say, despite the marking here, government bonds on the short end are very attractive right now. So given that the yield curve is inverted, the short-term bonds are yielding higher than long-term bonds. Those are becoming really attractive as a more of a temporary situation. But 10, 20, 30-year bonds still don't have a lot of utility, in our opinion, at the moment, given what's in front of us. And then, as I mentioned, when's the time to look back at developed market international stocks? It's when the dollar starts declining. So that's just kind of frames out our opportunity set, if you will. A couple of updates here. I just wanted to introduce, the concept of where we are right now, between now and when inflation does ebb, at looking like the end of Q2 next year. We're kind of in this no man's land. Where no man's land, of course, refers back to World War I, the distance between the trenches, if you will, where there's a lot of action but not a lot of progress being made. And so, in those types of environments, again, I think it's still important to remain conservative, have some cash and cash equivalents on the side to be able to react to very short-lived opportunities. But that's certainly something that we continue to implement across most of our strategies. Alternative strategies actually in Q3 did a in my opinion, very good job of bolstering or finding a way to generate a positive return when both the stock market and the bond market were down somewhere between 4 and 5%. So definitely finding a lot more utility in I think Q3 was a great example of why you would even want to consider things like alternative strategies, whether they be public market strategies in mutual fund format or private market. Those had a great quarter, especially in relative terms. And that's something that we've put a lot of research effort into to continue to identify attractive options on that front. Just before I turn it over to Mike, that we'll run through a few more slides here, but just important, one of our advisors was talking about this the other day, so I thought it was useful to just introduce this idea, which is, we do have, I think, a tendency to look back on what's performed the best and want to stay there for some time. You can see, the returns by index or asset type by decade. And believe it or not, of course, the 2000 to 2010 period, S&P 500 returned almost nothing. I mean, it was very close to a zero return for 2000 to 2010. But interestingly, international stocks had a positive 30% return during that time. And more importantly, emerging markets, which we have no exposure to right now, had a 200+% return during that time. So, this is why I think it's important, as the title suggests, importance of being nimble is super important, because, it's likely going to be the case that stocks are going to be pretty volatile until we work our way out of this inflation period. But in the meantime, we have to, make sure we're keeping an eye on what other asset categories and asset classes are doing. And that very well may be reducing our U.S. equity exposure at some point in favor of other things that have a better starting valuation. So just wanted to kind of reintroduce that concept here. Interestingly, of course, the U.S. market 2020 to Q3 of 22 is the only index with a positive return. So just an interesting observation. I think we touched on this, very challenging year for stocks, led down by the Chinese market, which looked like it was going to buck the trend. But I think, we've still got a lot of work to do in the Chinese markets, property issues coming to the fore before we can get any more excited about Chinese stocks or international emerging market stocks for that matter. Just a couple of final things here before we go into comments from Mike. I have heard a lot recently talked about earnings estimates need to come down for Mike Wilson at Morgan Stanley talks a lot about this. And these are the aggregate estimates of all analysts for both 2022, where we're going to end up, as well as 2023 in the green line. Interesting that both of those estimates for 22 and 23 are coalescing around this, between 7 and 8 range. And I think in that regard, that's not a catastrophe by any stretch. Yes, 22 estimates have come down from, call it 11 to 7.5. But again, I think the PE multiple going down as much as it has this year is certainly reflecting this downside to earnings. But more importantly, 23 earnings are not falling off a map, and they're nowhere close to going negative at the moment. Now, I know revisions are continuing to come in, so we certainly have to keep that top of mind. But as of right now, we just don't see this calamity in the equity markets that's on the horizon that a lot of folks are thinking is just right on the cusp there. So as I like to say, we're kind of bumping along the bottom. There's another reason for that is that, again, going back to pessimism in the markets, this just tells you one rough proxy of that. It just tells you how many stocks in the S&P are trading above their 200-day moving average, which is the long-term moving average. And for one reason or another, when you start to get to these levels of 10 or below, which we were almost there, I think it was last week or 2 weeks ago, the revision or the reversal off of that level tends to be very meaningful. And you can just see, some of these levels where it got to that point at the end of the bear market in 2002 is when we got to that level. Middle of stages of the financial crisis in 2008-9, European financial crisis was right around here, COVID, and then here we are. So, the market has definitely priced in, at least stocks have priced in a lot of negativity and pessimism that is starting to show up in some of these indicators. And there's a few other things that we could touch on, but I think I wanted to leave you with some takeaways so I can leave some time for Mike. And that is, we certainly don't want to discount the fact that 2022 has been a very challenging year for a lot of us, certainly that are investors, but also just psychologically, it can take a toll. But, it's important to realize we have been mitigating a lot of the impact that maybe would have been there with some of the moves that we've been doing so far, like up to this point. We're at the lowest level of bond exposure we've been at ever since I've came to the firm in 2008. So, just to give you a sense of what that means, our average 60-40 has gone from 40% in bonds to 17% in bonds. That's a pretty meaningful shift. And we're trying to identify strategies like alternative strategies that can benefit during these levels of higher volatility. And I think we highlighted one of those strategies that are doing quite well this year called trend following or managed futures strategies that are having banner years because the trends haven't shifted in some of the markets that those strategies are in. And it's just important to keep in mind that there are things going on behind the scenes here. And then finally, I think despite what Ray Dalio said 6 to 9 months ago, where cash is trash, I think he's coming around to that realization or reversing course on that because, cash is actually earning a decent rate of return now, or cash equivalents, not necessarily money markets per se, although those are shifting upwards, but more, 6, 9, 12-month bonds are actually yielding us a pretty decent return. And in some case, the case of treasuries, you're over 4 on a 1-year bond. So that's a very sizable shift from where we were just 9 months ago. So with that, I'm actually going to leave it there. And by all means, if you have any questions as Mike and I go along, feel free to lob those into the chat function. I'll grab those out of the chat function and pose them to Mike here at various points if there are any. But with that, I'm going to turn it over to Mike. And Mike, take it away. Well, let's kick it off.
Thanks so much, Todd. And hi, everybody from sunny Washington. As Todd said, my name is Mike Townsend. And at Charles Schwab, we have a little office here in downtown DC. There's 5 of us. And it's our job to watch what's going on Capitol Hill, in the halls of Congress, the White House, regulatory agencies like the SEC and the Fed, and really just try to figure out what it all means for investors. I kind of think of my job as trying to help you cut through all the noise and the nonsense that comes out of this town. And believe me, there's a lot of both. And, sort of make sense of what's really worth paying attention to. So that's what I'm going to do today, talk a little bit about what Congress has been up to, talk about what the regulators have been doing, and then we'll end with a look at the midterm elections, now less than 4 weeks away. So, Todd, if you could go to the next slide, I'll just start by saying, this is typical of a narrowly divided Congress, where for much of the first year or so, not much happened, and it kind of got branded as a do-nothing Congress until all of a sudden they did a bunch of things. And that's kind of what's happened over the, the last, 3 to 4 months, I would say. Really started back earlier this year when the Russia invasion of Ukraine happened. And not surprisingly, 2 very quick, very overwhelmingly bipartisan supported aid packages totaling about $54 billion passed pretty quickly. And then as we moved into the summer, we saw things like the first bipartisan gun legislation in more than 2 decades. We saw a veterans health care bill pass. But I want to flag that third bullet, which is this bipartisan bill to boost the U.S. semiconductor industry and help us compete with China. A couple important things to know about this. About $54 billion is going directly to aid the U.S. semiconductor industry. And if you want a symbol of how significant that is, Within the week of that being signed into law in August, we saw Intel break ground on a huge $20 billion semiconductor plant in Ohio. We saw Micron break ground on a $15 billion plant in Idaho. We saw TSMC, which is the big Taiwanese semiconductor manufacturer. They're building a plant in Arizona, and they'll certainly benefit from this money. So, some potential opportunities there, I think, in the semiconductor sector, because this is a really significant infusion of support from the government. The other part of that bill, about $200 billion of it, is going to ultimately go to helping the U.S. All the way down to the high school STEM education level through college and university, and then ultimately partnering research universities and businesses to create these kind of tech hubs that really promote competition with China in kind of cutting edge fields, AI, artificial intelligence, quantum computing, rocketry, that sort of thing. And over the next several years, there's a lot of money going towards those kinds of fields, which I think is also significant. And then, of course, down at the bottom, the most recent accomplishment, Congress passed the Inflation Reduction Act. Now, this was not at all bipartisan. This was the bill that passed through a special set of rules in the Senate that allowed Democrats to pass it without any Republican support, passed the House without a single Republican vote, but a significant bill for climate change and deficit reduction. And I'll dive into that a little bit on the next slide. As we look at sort of the economic agenda, just to provide some context for sort of how money appropriated or awarded by Congress gets out there. You probably recall that last fall, there was a big $1 trillion bipartisan infrastructure bill that was signed into law. And that's a really significant investment into roads and bridges and airports and broadband expansion in rural areas and that sort of thing. But that takes a while. And in fact, the administration in August just announced the first 166 projects that will be funded by that bill. But really, there's a huge lag in Congress passing something of that size before it really gets out there and working in the economy. And some of that is about infrastructure projects have to go through permitting and all that sort of thing, and compete for grants and awards and all that sort of thing. So it just takes a while. And I provide that context because when we think about the Inflation Reduction Act that was signed into law in August, and we think about this $370 billion effort to combat climate change, lots of different tentacles to that, but really what it's about is helping the U.S. manufacturing process become more green, to help really invest in different kinds of green technologies and green energy sources. But it's going to take a while. So a couple of specific individual things to note in that bill. One is that the tax credit that was set to expire for individual homeowners who do supply, repairs to their home that are green in nature. So if you purchase, a energy efficient heat pump or energy efficient windows, or you put solar panels on your roof or something, there was a tax credit that was set to expire that now has been extended for several years. The other one that's worth noting that I think people have heard a lot about, there's a new $7,500 tax credit for purchase of an electric vehicle. But there's a bunch of caveats to this that are really important to understand if you're sort of starting to think about electric vehicles down the road. One, there is an income cap on who's eligible for it. Two, there's a cap on the cost of the vehicle, $55,000 for an electric vehicle, electric car, $80,000 for an electric van, SUV, or truck. But the most important aspect of this tax credit is that it also requires that the electric vehicle be manufactured here in the US. So that takes right off the table BMWs and Kias and Hyundais that are not fully manufactured here in the US. And probably even more significant, the battery for the electric vehicle has to be sourced from the US or from a US trading partner. And what that means is even the minerals that sort of make up that battery have to be sourced from a US trading partner. Why is that important? Because the vast majority of electric vehicle battery makings are currently sourced from China, which makes any battery in any vehicle that has that sourcing ineligible for the tax credit. And frankly, it's going to be a couple of years before the U.S. sort of manufacturing process has caught up. So as you're thinking, if you're thinking about electric vehicles, just keep that in mind. The number of electric vehicles that are actually going to be eligible for this tax credit when it kicks in next year is really, really small, at least initially. So just something to watch. One other comment about the Inflation Reduction Act, a lot of attention being paid to the fact that there's an $80 billion increase in IRS funding over the next several years. And you've probably seen the commercials or seen, various people talking about, images of, 87,000 armed auditors roaming the streets of suburbia or something like that. What the IRS is going to do with this money first is pretty basic. They're going to hire people to answer the phone because you have like a 1 in 10 chance of having your phone call ever answered. They're going to hire people to just go through the backlog of unprocessed returns from the last couple of years. But I do think down the road, this bill is about expanding the enforcement of the tax law. And what that means is probably an increase in audits 2, 3, 4, 5 years down the road, but probably an increase in audits for wealthier filers. Does that mean that wealthier filers are going to be audited at some huge rate? No, the rate is still really, really low, and it'll just be a tiny bit less low. But certainly something that's attracting a lot of attention politically as we head into the elections. The other thing about this bill, of course, is that it's way smaller than the president had initially hoped for. So a lot of things that you heard the president talk about over the last year or so, paid leave, universal pre-K, childcare and elder care support, all those things ultimately had to be dropped from the bill. A couple of other quick things to mention on the economic front. A lot of attention being paid to the president's call to reduce student loans by $10,000, $20,000 if you have a Pell Grant. Very controversial. There's a lot of question about whether it's even legal. There have already been court challenges filed. So this is going to be, I think, in limbo for a little while until the court sorts it out. And then finally, what just happened in the last couple of weeks, Congress did push out government funding through mid-December. Basically, what that means is the government's fiscal year started on October 1, and each year by the end of September, Congress is supposed to pass all the appropriations bills that fund every government agency and every federal program. They almost never get it done on time, and this year they passed exactly 0 of the 12 appropriations bills. So what they did is they basically just kicked the can down the road, said, keep the government open and operating, no government shutdown, and we have a new deadline of December 16th. Keep that deadline in mind, because that's going to be tricky after the election. Congress is going to come back. And remember, this is the old Congress after the election, not the newly elected Congress that'll take office in January. And they're going to have to wrestle with that new deadline. And the potential for a government shutdown but right before the holidays does exist. So it's definitely something that we want to keep an eye on. If you go to the next slide, Todd, I just want to touch briefly on taxes, because the discussion around taxes over the last year has been a really interesting one. Probably everyone on this call remembers, a year or so ago when the first bill that ultimately became the Inflation Reduction Act was introduced, really focused on increasing taxes on wealthy individuals. So it would have taken the top individual income tax rate back to 39.6. It would have created a new top capital gains rate for wealthy filers, would have reduced the amount that you could exempt from estate taxes and that sort of thing. As this bill moved through the process last fall, all of those ideas fell by the wayside, and there was sort of a pivot to kind of really focus on the wealthiest of the wealthy. So there was going to be a surtax on income above $10 million and that sort of thing. Of course, that's the bill that collapsed in sort of spectacular fashion in December, and all of that went away. So there were no tax increases last year. And at the time, at the end of last year, it sort of felt like it was a long shot that this bill would ever sort of come back to life. But when it did reincarnate itself over the summer, huge change in focus from individual taxes to corporate taxes. And ultimately, the new law, the Inflation Reduction Act, has 2 big changes to corporate tax law and no changes at all to individual tax law. The two new corporate tax changes, a new 15% corporate minimum tax. Really what that means is for large companies, so we're talking companies with $1 billion in profit over a 3-year period, over 3 consecutive years, those companies that are then paying an aggregate tax rate below 15%, they'd have to come up to 15% starting next year. So think of it kind of like the alternative minimum tax for individuals. And what that means is, there are a variety of companies potentially impacted: Amazon, Apple, but also in sort of non-tech companies. UPS is in that category. Berkshire Hathaway is in that category. Verizon, even General Motors is in that category of companies that are probably going to have to see their taxes come up. And then the other one is this new 1% tax on stock buybacks that kicks in next year. Wouldn't be surprised to see a little flurry of stock buybacks here before the end of the year in advance of that tax. But the sense in the business community is that 1% tax on stock buybacks probably not a significant enough tax to really change behavior. And if Congress's goal was to sort of discourage buybacks, I'm not sure that they're going to be ultimately happy with how this comes out. So if we go to the next slide, I wanted to flag one other legislative issue that I think people should be aware of, and that is that we do think there is a retirement savings bill coming down the pike that could pass before the end of the year. It's kind of known as Secure Act 2.0 in honor of the Secure Act, which passed at the end of 2019. As you'll recall, the Secure Act raised the age at which you have to start taking required minimum distributions from your retirement account from 70 and a half to 72 beginning in 2020. Well, this new bill would take that up to 75. The question is how it would do that, and we still don't know the answer to this. The House bill, which passed last spring overwhelmingly with strong bipartisan support, would take the RMD age to 73 next year, to 74 a few years down the road, and ultimately to 75 in 2032. The Senate bill goes directly to 75, but not for a decade, until 2032. And there's a sense here in Washington that doesn't make a lot of sense. I mean, it doesn't make sense to sort of pass something and say it's going to take effect in a decade, because lots of things can change between now and then, and who knows, maybe it gets undone. So the House and the Senate are right now kind of engaged in some behind the scenes negotiations over that provision to figure out, there's broad agreement we were going to raise the required minimum distribution age, but the manner and the timing of it is still a little bit fuzzy to us. So we're going to be following that. We'll obviously be communicating out once we know exactly what's going to happen. I think the timing of that is probably in the December timeframe. That's when the original Secure Act passed in 2019. And what I think is going to happen is this retirement package is going to get glommed onto some larger, big government funding bill and pass right at the end of the year. A couple other things to note: increased catch-up contributions for people approaching retirement age. Again, the details have to be worked out, but I think that's going to be part of the package. And then there's lots of stuff in this bill that's good for retirement plans, 401k type plans, in terms of helping companies start a plan or helping employees, get eligible quicker and that sort of thing. So definitely something to watch, as I think this is coming down the pike here before the end of the year. If we switch gears a little bit on the next slide, I thought I'd just talk for a minute about what's going on at the SEC. The SEC has been really busy. They have this huge agenda of different rules that they're thinking about. Bloomberg recently called it the crackdown on everything, which I think is probably a good way to think about it. I'm not going to talk about 53 different things, but I do want to mention 2 things that I think individual investors should be aware of. One is that the SEC is at the front end of proposing some rules to kind of overhaul really the way the market works. Some of this comes out of the meme stock frenzy that happened a year and a half ago, when you saw GameStop Corporation and Bed Bath & Beyond and these other very low price stocks suddenly get kind of boosted up by retail traders and really go on these crazy roller coaster rides. What happened in part of that, as the SEC looked at it, was concern that the SEC that a lot of young new investors are making trades on their phone, and some of those apps are kind of pushing them towards maybe making riskier trades or more frequent trades than they would otherwise make. And that they've kind of, the SEC refers to this as the gamification of stock trading, and basically saying hey, we need to make sure, do a better job at making sure that investors are educated about what they're doing, about what their trades they're making. So that's something that's coming down. The SEC is also looking at really what happens between when you push trade on your computer and it disappears and then it comes back and it says, here's what happened. Where were the conflicts inside that market plumbing? Were there payments being made along the way? Was money changing hands depending on where that trade got executed? And probably most importantly for individual investors, you are supposed to get what's known as best execution. That's the law. And that you are supposed to get sort of the best outcome from your trade that's available at that time. But it's hard for investors to know whether that really happened. And you sort of get it and you're like, well, that's the price I got. And I think you're going to see more disclosure to investors about exactly what happened, where your trade was executed and why it was executed there, because hopefully you got the best possible price. So those are some things that are happening already in the queue. The SEC has proposed shortening settlement times, which is, today when you make a trade, it settles 2 days after the date of the trade. They're shortening that to 1 day, and that should kick in 2024. And the second topic that's getting a lot of attention is this very controversial rule that would require public companies to disclose more to investors about their climate risk and their impact on climate change. This is a rule that, when the SEC proposes a rule, that then puts it out for public comment, and there's a period where, anybody can comment in. And, a typical rule gets, 200, 300, 400 comments. This climate disclosure rule, 15,000 comments have come in, which I think really illustrates how controversial this is. The SEC was hoping to finalize that rule this fall. And, the concern is that while it's supposed to help investors have a better understanding of the climate, the risks posed by climate change to different companies, there's, I think, a real question in the business community about how you collect that information and present that information. And can it be done in a way that's comparable across companies and all using the same kind of standards for it? So that rule, I think, is going to be delayed until 2023. Would not be at all surprised. In fact, I can almost guarantee it's going to be challenged in court if and when it happens. And then kind of related to that, the SEC has proposed a rule that tries to get at the names of funds, mutual funds and exchange traded funds, and says, look, if you're going to call yourself ABC Green Fund, you need to have some sort of standards around what that even means. Because if ABC Green Fund is defining green in one way and XYZ Green Fund is defining it in a different way, that's not helpful for investors if they can't sort of compare those across the two different funds. So the SEC is trying to kind of standardize fund names and basically say, if you're going to use these names, you've got to A, have an agreed upon sort of set of what that means, and B, invest 80% of the assets in the fund have to be in assets that sort of reflect that name. Unfortunately, the way they've done this, it would apply not only to things like green funds and sustainable funds, but also to a lot of other words like value fund, growth fund, international fund. So there's a concern that maybe the SEC has kind of overreached on this. We'll see how this one plays out. On the next slide, I wanted to just touch quickly on an issue that has gotten a lot of attention, both from investors and increasingly here in Washington, and that's cryptocurrency. Huge interest in Washington in putting some kind of regulatory framework around cryptocurrency that just really isn't that structure. Nothing like obviously what the equity markets or the bond markets have sort of around them in terms of rules and investor protections and that sort of thing. But there's a lot of uncertainty and there's a lot of different sort of cooks at the kettle here. It's not totally clear who's in charge. Is it the SEC if it's a security? Is it the CFTC, the Commodity Futures Trading Commission, which oversees derivatives and commodities trading? That's not totally clear who's in charge. Then you have all sorts of different parts of the government sort of touching this issue. Labor Department's very concerned about whether crypto should be allowed as part of a retirement plan investment choices. Treasury is really worried about financial stability and about money laundering and using of crypto to fund illegal activities. The Fed is looking at it from, should the Fed launch a central bank digital currency, which lots of countries are thinking about doing in order to sort of, put some kind of Fed structure around cryptocurrency. So all these different agencies have been weighing in response to a White House executive order from earlier this year that tries to kind of get everyone's recommendations about how to put a structure around this. Ultimately, this is going to come down to Congress, and there are several bills that have been introduced that'll sort of clarify the rules around cryptocurrency and help protect investors. I don't think that's going to get resolved here before the end of the year, but I think this is going to be a big issue in 2023 because as cryptocurrency continues to be popular and increasingly popular, putting that kind of structure around it, I think is important. On the next slide, everyone's talking about the Fed these days. Todd touched on this a little bit, so I won't spend a lot of time on it. I think everyone's aware of where we are. I think at the last meeting in September, no great surprise that there was another 75 basis point hike. But I think there was a little bit of a surprise that the target for the SEC's, where that rate they want to get it to keeps creeping upwards, now north of 4.5%. And so that implies, another 125, 150 basis point type of hike over the next couple of meetings. 2 more meetings here before the end of the year. I looked the other day, the odds for a fourth consecutive 75 basis point hike at the November meeting are currently north of 80%. I think everyone sort of sees that right now as the likely outcome. There may be some change. As Todd mentioned, tomorrow morning, the CPI report comes out. We'll get the latest inflation numbers. I think that has implications not only for what the Fed does, but actually has pretty significant implications for the midterm elections because a lower number than expected probably helps Democrats to be able to say on the campaign trail that it's turning a corner, inflation's coming down. A higher number gives some ammunition, I think, to Republicans that things should be changed. So with that, let's go to the next slide, and I'll jump into the last portion of my comments before we take a few questions. And that's kind of the lay of the land here on less than 4 weeks out from the election. So as I think everyone knows, super narrow majority in the House. It's a 50-50 tie in the Senate. So all these races are going to be really, really important. When you think about the history of midterm elections, they are notoriously terrible for the president's party. So you see here, president's party has lost seats in the House in 17 of the last 19 midterms, lost seats in the Senate in 13 of the last 19 midterms. Actually, if you go back to the Civil War, there have only been 4 midterms since the Civil War in which the president's party has actually gained seats in the House. So that tells you that, there's enormous historical headwind facing the Democrats. On the next slide, we can look at another part of the headwind facing the Democrats. This is a chart from 538.com that looks at the presidential approval rating. And basically what they do is they sort of aggregate the polls and weight them differently depending on how they're done and give you kind of a consensus average. And so you see, even though the president has ticked up some over the last 3 or 4 months, still we're well below 50% approval rating. Why is that a significant line? Well, on the next slide, you'll see a chart that looks at all of the midterm elections, the first midterm elections of new presidents going back to Truman. And you see in red here, there have been 7 times where the president's approval rating was below 50% at the time of the midterm elections. And the average loss in the House has been more than 40 seats in that situation. Remember, Democrats have a single-digit majority. It would take 6 seats to flip in order for Republicans to gain control. Historically speaking, you're talking blowout territory given the circumstances. On the next slide, you'll see one other factor that comes into consideration when you're talking about the House elections, and that is that this is the first election after the 2020 census. So there's a reapportionment, meaning states that lost population over the last decade potentially lose a seat in Congress, while states that are gaining in population get more representation in Congress. So you see here in yellow are the states that lost a seat in Congress, meaning the number of seats they have right now in Congress is going to go down by 1 starting in January. California lost a seat in Congress for the first time in its history. And then you see that little pocket of sort of upper Midwest and northern states that have been declining in population for a while. Texas is the big winner. They got 2 new seats in Congress, and then you see the other purple states are the one that gained 1 seat. The other thing that goes along with this, though, is that these states, all of the states, redrew their congressional district lines as part of this redistricting process. And what has happened across the country and across really the last couple of decades is no matter who is in charge of that process, that has become so partisan and political that both parties have drawn really gerrymandered districts that really strongly favor one party or the other. And what's interesting is that there are 435 House seats on the ballot this fall, but I would say maybe 40 are really competitive. So you're talking about 10% of the House seats that are really competitive, and that's where all the focus is, because that's what's going to determine which party comes out on top. So then on the next slide, if we change gears for a second and talk about the Senate, because I really think most of the focus on election night and in the days afterwards is going to be on the battle for control of the Senate. As I said, it's a 50-50 tie. 21 Republican seats, those are the red states here, are up for re-election. 14 Democrat-held seats are up for re-election. But I think what's really interesting is, when you think about presidential elections, we all know about the battleground states, right? That 8 to 10 states that determine the election every 4 years, right? Those states that are going to be the key to the Electoral College. Well, in this midterm election, those same states are going to determine which party controls the Senate. And that's because the 6 states that were closest in 2020 in Biden versus Trump, all 6 have a Senate race on the ballot: Georgia, Arizona, Wisconsin, Pennsylvania, North Carolina, and Nevada. I really think those are the states where you're going to see the balance of power determined. There are a couple other states I have my eye on. Ohio could be competitive, New Hampshire, maybe Florida, but I would say these 6 states are really the ones that are going to matter. So what do we think is going to happen on the next slide? And here are the races that I did want to kind of highlight. These are the races that I mentioned that I think most competitive. And you see that Arizona, Georgia, and Nevada all currently held by a Democrat. North Carolina, Pennsylvania, Wisconsin, and Ohio all currently held by a Republican. So, in order for Republicans to get the majority, they've got to net out to 51, because if it's a 50-50 tie again, and I think that's a very real possibility, but if it's a 50-50 tie again, then of course the Vice President, Kamala Harris, has the tie-breaking vote, and Democrats would stay in power again. So, this is just a snapshot of where these races are now. I think in a lot of these states, first of all, you're just being absolutely pummeled with television advertising in these states. Most of it very, very negative. That cuts both ways. It can turn off voters, but we'll see how it plays out. But you see how competitive most of these races are in the polls, and that's an average of recent polls over there on the right. So how do we think this is going to play out? On the next slide, I continue to think Republicans are pretty heavily favored to take over the House of Representatives. If you had asked me 3 or 4 months ago, I think we're looking at maybe a 30 to 40 seat gain. Today, I think it's smaller, maybe 15 to 20 seats, and that matters. The size of the margin of the majority does matter, because it just gives whichever party's in power and has the majority. The bigger that majority is, the more sort of flexibility they have, within their own party. If Republicans take over the House, which I certainly I think is a likely outcome, I think you're going to see lots of investigations of the Biden administration, some score settling based on investigations that have happened this time. And that's just the way our political system works. But keep in mind, Republicans, if they're in charge of the House, they've still got to do basic stuff with the president. They've got to figure out a budget every year and that sort of thing. So I think that's going to be really, really tricky, but ultimately they're going to have to find compromise. As I said, I think the Senate is really a toss-up right now. If I had to guess, I'd give Democrats a slight advantage to retain their majority. A couple of things have happened over the last few months that I think are notable for Democrats, particularly in these Senate races. One is there has been some positive signs, with gas prices that came down for 99 straight days until finally ticking up more recently. But at least those kinds of signs that things are maybe heading in a better direction. I think also, Congress passed some stuff, as I mentioned at the outset, that Democrats are in control, gives them some accomplishments to talk about. And then, I think there's no question that the Dobbs decision that overturned Roe v. Wade over the summer has had a galvanizing effect on Democrats. There's been some sort of anecdotal polling evidence that kind of gives a sense that women have registered to vote for the first time at a much higher rate than men. A lot of that is attributed, people think, to the Dobbs decision. So we'll have to see how that plays out. I do think it's going to be really close in the Senate, and if it's 50-50 or 51-49, one way or the other, that's a recipe for not getting much done. And really important to remember, President Biden still has 2 more years, and he has the veto pen. So even if Republicans have the House and the Senate, they can't just do whatever they want because the president's going to veto it, and they're going to have such narrow majorities that they can't do anything about that. So on the next slide, I wanted to just wrap up with a couple of things that I get asked the most. And unfortunately, on this slide, my little red circle has slid down a tiny bit. I don't know how that happened, but the question I get most from investors is, what's the political configuration in Washington that's best for the markets? So we looked at 120 years of the Dow Jones Industrial Average and said, how did the market do on an annualized basis based on what the configuration was in Washington? In the middle there, you see that the most common configuration we have in Washington over the last 120 years is the one we have now. Democrat in the White House, Democrats controlling the House and the Senate. But the second most common is the opposite. Republicans in the House, Republicans in the Senate, Republican in the White House. And if I was able to magically move this red circle up, what you'd see is that the difference in annualized gain in these two situations is less than 0.5%. And why I tell that to people is to remember that the markets don't really care who wins the election. The markets don't really care about the horse race and how many seats are won or what the margin is. Ultimately, the markets care about what Congress does. So the markets care that Congress passed an infrastructure bill last fall because infrastructure is historically good for the industrial sector, good for the materials sector. It's just good for big companies that make machines that make roads. It's that kind of connection. The Inflation Reduction Act that passed in August, that's got some real incentives for green energy companies. So it's probably going to be good for companies that make wind turbines and make solar panels and companies that store energy and help get it from where it is, being captured to where it needs to go. So that's the connection that Congress and the markets have. It's really not about the race. And you'll probably see a market reaction to the outcome in the few days right after the election, but those almost never hold for more than 7 days. So I'll say all that just to remind you as an investor that, you may feel really strong emotions about how your team is doing or how your team is not doing or what the election outcome is, but the market really doesn't get affected by that. So don't let your sort of political emotions get riled up to make any kind of investing decision that doesn't make sense. And then I've got one more slide to show, and this is just an interesting one. Maybe is a little sign of something for 2023. This chart just looks at how the market performs in each of the 4 years of a presidential term. And over on the far end on the right is what would be 2023. And historically, the market performs best in the year before a presidential election. So 2023 being the year in question here. And you see that the average market increase is the bottom part of that little bar chart, 13.5%. And the top part just says that the market has gone up more than 78% of the time in that year. So, of course, there are lots and lots of factors that potentially affect the market, and this is only one sort of anecdotal one that's kind of a more fun. I certainly wouldn't rely on this for anything more than just an interesting look at how the market performs in different situations. So with that, I've got a couple disclosure slides that Todd, I think you need to flash through for a second or two, and then happy to take any questions that people have. Thanks so much.
Sure. Thanks, Mike. And just a reminder, if you do have any questions for Mike, feel free to drop those into the chat function and I'll grab them off. And we have had a couple come in already. So I'll just, and I think we probably got time for maybe just one of these before we hit the end of the hour. And I think the primary one that I've seen maybe a couple times from clients is, this is a really, expansive rundown of what's going on in Washington. But of course, you've got this other kind of nagging issue off to the side, which is, the relationship with the U.S. and China. So, and that tends to be, well, I don't know, you tell us, I mean, does that tend to be a partisan thinking on how, we should be interacting or engaging with China, or what's the general sense of the U.S. relationship with the second largest trading partner?
Yeah, there's a lot of concern right now, no question. And, it really isn't especially partisan because, think of right now, we have still the Trump tariffs in place that President Biden has not undone those. There's been talk about whether he would lower some of those or not. That hasn't happened. And I think that's because of the complexity of the relationship. And look, there's no question the relationship got even more complex over the last couple of months as Beijing really increased its saber rattling around Taiwan. And you've heard the president be pretty specific on his willingness to potentially go to the mat for Taiwan. There's a lot of concern about that. What I think is going to be interesting is, we have a G7 summit or G20 summit coming up at the end of November. President Biden and President Xi Jinping of China have not met face to face since the president took office. They have talked on the phone a few times, but do they meet face to face on the sidelines of that summit and start to talk about some of these issues? The other interesting one, I think, obviously, is how China has positioned itself around the Russia-Ukraine invasion. We saw President Putin and President Xi met a few weeks ago, but I think you're going to see President Biden try to really continue to put the pressure on China to be more forceful in condemning the invasion. The other thing that I think is interesting is, the situations are very different. But obviously, Russia has wildly underestimated what they thought would happen, I think, when they invaded Ukraine. And is there a lesson there from China for China in terms of Taiwan? We do not think an invasion of Taiwan is at all imminent. We think saber rattling and exercises in the Taiwan Strait are going to continue, but we just don't sense that really makes sense. But there's a heightened sense of tension here in Washington around that aspect of the relationship, and that colors everything. And so I think it's going to be interesting over the next 3 to 6 months to see whether President Biden and President Xi do sit down and start to talk about these issues and maybe unthaw some of the communications that haven't been happening there.
Great. And I do see there's a few others in here, but I think we'll have to address those offline. Mike, thanks so much for joining us today. As always, it's been a great learning opportunity for, I think, me and a lot of the clients on this call. And hopefully you can join us again sometime in the future where you can give us a rundown, maybe in advance of the next election at the end of 23. So we always appreciate your thoughts. So thanks everybody for joining us. And we look forward to talking to you again next month. Take care.